So all you have to do is turn in the handout. The handout's the only thing you need to turn in for chapters 1, 2, and 3. And for chapters 4 and 5, I'm going to break up the handouts into different sections. So tonight we're going to do chapter handout for inventory. We're going to do other parts of it too, but we're going to separate those out. There's actually quite a bit in there. It's yeah, so there's not going to be a test for chapters 1, 2, and 3. Chapter 4, the handouts, we're going to break them up. There's going to be an inventory one. There's going to be property, plant, and equipment. There's going to be a few other ones in there. Just to kind of let you know how the book is laid out, 4 and 5 really gets into the differences between the international standards and Gaap. And oftentimes they'll ask questions on the CPA exam. It was the ACCT put on an announcement that they're going to start de-emphasizing the differences between Heifers and Gaap. And I think that's just because they were doing it so heavily. But they're probably still going to have some differences between those two because they are significant. And if you have a company that has international subsidiaries, which the big companies all do, you're going to run into it. All right. So what we're going to do today is go into the we're going to start in chapter 4. And we really start going into the different costs of the different systems, basically, how they account for something. And you guys cannot see my screen. Okay. So hopefully you got this handout. It's in Blackboard if you don't have it. It's also in under the assignments. It should be in your email too. Is there anyone that doesn't have it?
I've got it.
Yeah, okay. Okay. So Heifers and US Gaap, they're two different sets of rules. And they're very different in kind of their basis. And it kind of goes by the way that they're going to kind of run their countries too. There are some real quirky things about the United States. We don't realize that because we live here, but there's a lot of things, that are sort of quirky. And one of the things that's really quirky about US business and our laws and all that is they're very definite in what they say. There's a right way to do it, there's a wrong way to do it. Basically, it's black and white. Whereas the international standards are much more judgmental. I should say judgmental, it's a bad word, but they use judgment a lot more. That they look at, okay, is this really an asset, or is this a liability, or what is this? Because a lot of things don't fit into, easily into the our formulas. In accounting, we only have really 5 different categories. We have revenues, expenses, assets, liabilities, and equity. Those are 5 categories. And that's pretty much everyone in the world has those 5 categories, and how you fit things in there can be very different. So anyway, we'll go through this chapter. The chapters here on out are going to be a little bit more, technical, but you're going to be doing a little bit more work, more calculating, and all that kind of stuff. But which I think is good anyway. I think it's a lot of times we went into accounting because we're pretty good with numbers, so working with numbers is usually a little easier anyways for most of us. Okay. Oh, I'm missing an I. Heifers is more flexible in many cases and allows for alternates between treatments of accounting. You'll find this in general that for a lot of things that they'll have more flexibility, not all things, but some things they'll have more flexibility. That you can account for it this way or that way. Less rule-based than you know, the Gaap, word that kind of funny. So Heifers is a principle-based system, and Gaap is a rule-based. And today we're going to look at inventories. Okay. There are some things in the inventories that are the same. There's some things that are different than US Gaap. And what we're going to do is, generally, we are, instead of just focusing on the differences, a lot of times it's easier just to work the problems out and then figure out what the differences are between them. And that's kind of what we're going to do here. Okay. So here are the costs that are allowed under the international standards. So we have costs of purchase, cost of conversion, other costs. Specific for customers' interest, takes time to bring in saleable condition, normal waste, all that kind of stuff goes in there. And most of these are the same as for US. The big one here are the design costs. So design costs are not allowed under Gaap rules. Under Gaap rules, design, those are all considered, will be expensed. So, you know, research and development, when you get something ready for the market and all that kind of stuff, those are all expensed. You can't put them into the product. European standards say if it's for a specific customer, especially, you know, if you're designing this for certain people and they want certain things, they want it in a red box or whatever it is, that those things are going to the cost, whereas the US says. So we're gonna just, and this is a kind of a simple one to do. Inventories exclude abnormal waste. So there's a normal waste and abnormal waste. So normal waste is what you usually have, and for some things it's common. If you're working with wood or stone or something like that, it's not uncommon to, you know, get a piece of wood that you can't use. No, it just happens sometimes. You can't have natural wood without having natural flaws in it, and same thing with rock and things like that. So there is a normal amount of waste. However, there can also be an abnormal waste, and that is things that are above the normal, you know, that go beyond what you would expect. Storage costs are not allowed unless they are necessary for production. Administrative overhead. And selling costs. Okay, so those are those things that these are things that are allowed for it to go into the cost, and these are the things that are not excluded. Okay, so let's go here. So purchase of wood. Under Heifers allowed, and under Gaap is allowed, right? We have purchase of wood, that's normal. Wood storage costs. That's allowed under Heifers. I don't have it up there. I should put that up there. It is not allowed under Gaap. Conversion costs into chairs. Design cost. Allowed and not allowed. Let me change this up here. I have room. I think I have room. Okay. Finished chair storage, neither one of them allow for that. It's only for, the only thing they allow is for the raw materials to be stored. The rest of this is a selling expense. Normal waste. We actually agree with each other on this one. And abnormal waste. And just so you know, like for instance, you're making a chair. You get a piece of wood. Sometimes you can't use a piece of wood. It's got a flaw in the middle or whatever. That's normal. Now, if you have your machines calibrated wrong and it tears up a chair or something like that, that's abnormal. So kind of separating it out between, just working with wood in general, is you're going to have some waste that sometimes you have boards coming in that you can't use. However, if it's caused by something else, something on your production, then it's abnormal waste, and that's does not go into the cost of it. Okay, so we have to add these up. Time for the calculator. I got my calculator. I got my where's it? That's the better camera. Okay. So it's the 106,000. And over here, I do this one in our head. This would be what? 40, 90,000. Okay, so these would be. Yeah, that looks worse. Okay, so this would be the difference between these two. So this would be the Heifers, and this would be the Gaap. Okay, now that difference is. What? 16,000? So the question is, what happens to that difference? Okay, so let's say that you have a chair production and it's being made in a different country. These are the dollar amounts in US dollars. They've already been converted. What happens to the 16,000? So they'll have 106,000 in the inventory. When we translate it over to US standards, it'll be 90,000. So what happens to the difference? What happens to the 16,000?
Are they included as an expense?
Yes, that's exactly right. Oops, what am I doing? The wrong camera. I'm sorry. Yeah, could be an expense. That's exactly right. So there'll be expenses of. So this will be expense for US GAAP. And again, these are just differences in the rules that are going to cause the differences. Okay, inventories. Inventories actually have a kind of a large. They can have a large impact. As you can imagine, you take some retailers, make something like Walmart. Most of the value of that company is in inventory. The inventory runs through the stores. The stores are important, but managing that inventory is really the name of the game. And so there are differences in the inventory, the way that they can use it, show it for US standards versus international standards. And here's where the one really big sticking point comes in. We have, you guys in your other classes, you have LIFO and FIFO, right? FIFO is first in, first out, and that's really the way that things usually go, right? If you're in a grocery store, you sell the milk, that's 2 days old before, the ones that are later on in the period. So, for instance, if the store got milk in on the 15th, well, that's obviously not the milk they sold on the 2nd. Right, the first one's in where the first one sold. So the milk that they got in first was sold. Well, later on, whatever. So what FIFO is the normal flow of things. LIFO is a completely US standard. Last in, first out. And it comes about because it's for theoretical income, basically. Economists will tell us that the last price, the most current price, is the most appropriate to determine your income. It's the most relevant. So the last price is for your income, for determining your income, it is the most appropriate to use. Nothing flows like that, though. The milk that they sold on January 2nd was not the milk that they bought on January 28th. It doesn't make any sense as far as the flow of things. It does make sense if you're looking at it from an economics point of view, and they say, okay, this is the most relevant cost. That's what we're going to put on our income statement. That's going to be the most accurate income. There's a problem with that. And the problem with that is beginning inventory. If the last one's in where the first one sold, that inventory, the beginning inventory, might be on those books for 40 years. If they never sell out all their inventory, you could have costs that hang around for decades on the books. And at some point, they become completely irrelevant. If you're a car manufacturer, who cares what the tires cost back in 1968? It doesn't make any difference. Compared to today, it doesn't mean anything. And obviously, they don't have those tires from 1968 sitting in their showroom, whatever. Those are long gone. So there's a problem with LIFO. International standards do not allow for it. Many US companies use it. They are starting to switch away from it. There is kind of and probably part of it's because of the international standards, but there's still quite a few companies that use LIFO, and it's believed to be a more accurate income. That's kind of why they do it. But anyway, international standards do not allow it. US standards do, and in many cases it's encouraged. And it used to be for taxes, you pretty much had to use LIFO. So we had this kind of weird thing where there's us against the world. The world says, okay, nothing flows like that. You don't have 40-year-old tires sitting on your shelves. The first one you got in were the first ones. So anyway, standard cost method, retail method. We could go into those. I'm not going to go into them just because the methods are exactly the same, but they say only if they approximate the cost, and that's true for GAAP also. Inventories that are not ordinarily interchangeable must be valued using specific costs. So if you have something that is, inventories that are not the same, you cannot lump them together and use, FIFO or average cost or something like that. You have to go through the specifically identify them. Goods and services for produced and segregated for specific projects should be specific identification. And an entity must use the same cost formula for similar inventories. This is different than Gaap. Okay, so Gaap allows for different methods to be used for similar inventories as long as they're included in the footnotes. So car manufacturer may have wheels and tires and all that kind of stuff. They may say that they value the wheels using LIFO and the tires using average cost. International standards, they have to use the same method for all of them. So if they're similar, they must use the same cost method. You cannot have different cost methods. Okay, so what we're going to do is a LIFO FIFO method, and this will be a little bit of a rehash. Okay. So, a foreign subsidiary sells toy cars. The following costs are US dollars, and it's a FIFO method. Okay. So they sell these toy cars. So this is a foreign subsidiary. We've already translated this into US dollars. I just realized I got the wrong thing here. Oh no. I have to change this. The problem is these are the same. Do me a favor, make this change. Change the cost to 12. I'm gonna do it on the following page too. When we get there, I'll change it. So change that to 12. That's a mistake on my part. If you think about it, if all the costs are the same, it doesn't matter what method you use. Average cost is gonna be $10. The LIFO $10, FIFO $10. So we got to change the cost, or else this is going to be a really boring problem. Even more boring than it is. Okay, so change this to 12 if you would, and we'll do it on the following page too. Actually, I'm going to go do it right now just so I don't forget. Although it'd be hard to forget that. Okay. All right, so these are in US dollars. And so each of these cars, a little toy car here. So we have this car is selling for $15 each, a little bit pricey, but and then we have the cost of $10 and $12. And the question is, which ones did we sell? International standards say, you can use average cost, but you can also use FIFO. So first in, first out. And that's what we're going to use for this one and to determine the cost. And the idea is that the first cost in were probably the first one that we sold. Okay. So our sales. And sales are usually pretty easy. Sold 160 of them. And we sold them at a price of $15 each. Way too much more. And so the total sales are, what are we at?
2,400.
2,400, thank you. Okay, so this is our total sales. Now, cost of goods sold are the idea is this, okay, we bought this car for some, $10 or $12, whatever it is. We sold it. Now, this is an asset. Because on our books as an asset. It could be $10, it could be $12, but it's on the books as an asset. Now, notice that when we sell it, it's gone. We've lost that asset. We haven't lost it, but whoever bought it wants to take it with them. So, we sold it. So this is the cost of our sale. So we got $15, we sold it. That's what we're gonna do. Okay. So we're going to assume that it's the FIFO method. The first one's in or the first one's out. All right. So we need the cost for $160 like cars. Hold that whole thing. Okay, so coming down here to our inventory, this is what we paid for them. Which ones were in first? The 1-1 or the 116?
1-1.
Yep. So we're going to first go to our beginning inventory and take those. We got 100 of those. Cost is $10 each. $1,000. Okay, so this is kind of like the colors on these. Okay, so the first one, $100, 10. So this will be folded and now these are gone, they're never coming back. However, we don't have 160, we still need the cost for how many?
60.
Yep. Good. We found the cost for 100 of them, but we still need to find the cost for another 60. And obviously there's only one layer left here, this one. Make that green. Now there's 130 in this layer. But we don't need to take all 130, we only need that's it. Oh, come on. I don't care. I'm gonna put it back the way it was. Who cares? All right, so we got 60 from this layer. And the price, the new price is $12. Equals. That's 720.
720, yeah.
Is it? So 720. Not bad. And this is gonna look ridiculous, but I'm gonna put it in there anyways. We don't need any costs anymore because we just found all of them. We have 160 of costs, and so this will be our total cost will be 1,000. So this is what we came in, this is what went out. And so then we're gonna calculate our cost of, calculate the gross profit for January. Okay, so we have our sales. 2,400. We have our cost of goods sold that gets subtracted out. These are gone. These are inventory that have left the place. We don't have them anymore, and they cost us this amount. And this will give us our gross profit or gross margin, same thing. $680. Check that. Yeah, 680. So this will be our profit. And our ending inventory. The ending inventory now. So we had 130 here. And of this 130, let me bring it over closer. We sold 60 of them. So these first ones up there, these are gone. Never coming back. Up here, this purchase of inventory we had on the 16th. What's one of them? 70? I think.
Yeah.
Yeah, 70.
Okay, so there's 70 left. So we don't have this anymore. This is gone. 60 of those are gone. Still was, that was bigger. Straight through doesn't the little line through it. I don't know. There's probably a way to adjust it. I don't know what it is. All right, so we have this inventory, this is what's left over. This is sort of like what was not sold, so the ending inventory is what was not sold. Okay, so. So we still have from the 16th. We have my cars. Oop. 70. Plus the new cost on those was 12. And what's it? 840. So the ending inventory, which is just not sold, basically, would be $840. And this is FIFO, and this is probably the most realistic. You know, as far as the actual flow of items. So first in, first out, which is really maybe a better way to say it is first in, first sold. Oops. So first in, first sold is the usual flow for it. It just makes sense that would be, and so that's why they the international standards allow for it. Okay, so going on to the next problem. Ford Society sells toy cars. Oh yeah, same thing. So now it's a US company. The US company uses the LIFO method. Last one's in or the first one's out. And again, this is a theoretical method. Nothing, usually things don't happen LIFO, last in, first out. It'd be hard to imagine something actually flowing that way. But it is allowed by US standards, and it's allowed because it's a theoretical best income. It's sort of like you are giving the most accurate income you can to the readers. And that's why we allow it. And it's encouragement. And when I was going through school, it was, you know, hey, let's get everybody on LIFO. That was kind of that, you know, it's theoretically the best income, and people make the best decisions if they had the best information. But nothing flows that way. It's just saying that the last, you know, the last costs are the most relevant. And that's the best predictor of future profitability, are the very last costs. And so that's why we use it. Nothing flows this way. It's a theoretical kind of method that no one else uses. We're defiant in our LIFO. Okay. So toy cars sold. Sales in general, you know, I'm sure you guys have picked up that are pretty easy usually to figure out. Whatever they paid you, and what did they do the last one? I can't remember how I did this. Oh, sales, toy cars sold. Okay. Okay, so they sold 160, is exactly the same as the last. Sold them off for the same price. $15. Not there. And so those are total sales and exactly the same as last time. Sales are whatever. Whatever they gave you, that's the sales. Okay. So, cost of goods sold, now this is where it's different. Toy cars, okay. Actually, I said, hey, cost of goods sold. And the goods are the cars. So we need the cost for 160. That's how many we sold. Last in, first out. Where do we go to find the cost?
The purchase of inventory.
Yep. Right there. So we are gonna go. Hey, how come I fit? Oh, I know, because I bold fixed it. Yeah. Okay, so purchase of inventory. So we had 130. The cost. Well. Time for Mr. Calculator. $1,560. $1,560. Okay, we still need the cost for some cars. Oh, toy cars. What do we need? 30. Okay, so these are gone. They're gone, they're never coming back. This beginning inventory. We need what, 30? Cost is, oops, $10. And it's gonna look totally silly, but. So this is, we don't need to find any more costs. We have cost for 160. And. You know, so this over here, what is that, 1860?
Yeah.
So this is our cost of goods sold. 1860. Okay, so the gross profit would be. Or gross profit or gross margin, same thing. Those probably both aren't exactly the same. Uh, $540. Oh. Wait a minute. Right. $540. Okay. Sorry about that. All right, so this is what we sold. This one left the place, so these are the sales, money coming in, these are the goods going out, this is how much profit we made on those goods. Okay, and down here, we have our ending inventory. Okay, so. Ending inventory, we sold, so the last ones in are gone. Sold 30. What, 70 are left? So these, we no longer have 100 of these. The invisible cross out will let us know that we don't have those anymore. So we have from this beginning inventory, we have 70 at $10, so this will be our ending inventory. Yeah, this is not sold. Or it's not sold, we still have, so toy cars. Let's see. $700. So that'll be our ending inventory if we left. Now, notice something very, well, I don't know if it's obvious, but it's a, this beginning inventory, it may never be sold using the LIFO method. You know, that beginning inventory, unless they sell out the entire inventory down to the, you know, down to the shelves. There's some of that beginning inventory maybe sitting around for years, decades, you know, theoretically forever. Which is another problem of using this method. And it's maybe even a little bit more complex in that international standards allow for market values to be used in some cases for inventory. US standards don't. So you could literally have something on the books, you know, car tires back when they were, you know, $8 a piece, you know, rather than 180. You know, you have tires in your inventory that are $8, which are really $180 tires, but you have them on the books at $8. And US standards do not allow for you to write that up. You know, to increase that market value for them. So you do have that problem of your balance sheet can have completely ridiculous numbers on it. Right? You know, so you think about your current ratio and all these ratios that people use for their balance sheet for the inventory. The inventory that's on the books at a fraction of what it's really worth. You can lead the wrong decision. So it's a trade-off between income, having the most accurate income you can, and having the most accurate balance sheet. There's a trade-off between those two. With US standards anyways. Okay, so let's see, the difference in income would be. Well, let's see, sneeze. All right, so the gross profit was. There's gonna be a better way for me to do this. I know, I'm gonna consolidate up here. You don't need this anymore anyways. Okay. Isn't it fun watching me learn how to use a computer? That's a hoot. Okay, so for Heifers, their gross profit was 680, which we included in their income. And their inventory was 840. Or Gaap, we would have a difference. Our income was 540. Inventory was 700. And just for ticks, the difference up here. So the difference here was this is going to Gaap, it decreased the income by 140. And down here, it would decrease inventory by 140. Oops. So we'd add less income and less inventory under the Gaap method. Question on that?
No.
Okay. And so, and these are one of those problems though, when you convert them, not only are you going to have to convert the dollars, but you're also going to have to convert it may also have to convert the methods that they use. Because some methods that we use aren't allowed by them and vice versa. So, converting the financial statements can be, it can be a headache. And now, when it comes to accounting, though, that's good for us. People, you can complain about how complex things can be, but at the same time, things that are very complex pay a lot of money. So that's why it's good to be an international accountant, because to go through those kind of things. Okay, let's go ahead and let's. Hopefully we'll finish up a little earlier than that. Lower cost or market. So let's say be back at. What time was it? Let's say 7:10. I'm gonna put this up here actually. So this is the first problem we did. Okay. Okay, the last thing we're gonna cover is the lower of cost or market. And it's a good one to cover because a lot of people do it wrong. When I was doing auditing, for whatever reason, I became an inventory guy. I think like on the first audit, inventory is so big and you have stuff coming in and being sold and purchases and all that stuff that you need people for. So anyway, whatever it is, I got tagged for being inventory guy, which I had no interest in, but whatever. So anyway, it was kind of funny about, I think when I first started auditing, I thought, well, these people have been working in this field for 30 years. They're going to know everything. And you really find out that that's not true. Most people, a lot of people anyways, they come into a job, they're told to do this, they're told how to do it. And that's as far as it gets. So a lot of times, you have this problem with people who, especially with things like lower of cost or market, who really didn't understand what it was and how to use it. So it is a good one to know. And lower of cost or market is actually very big. So it would not be unusual to have that on the CPA exam when you take it, at least in some form. So to be a refresher, and there are a few differences between, there's actually one big difference between the international standards and the US standard, which we'll get to. Okay. So, excuse me. So lower of cost or market, or net realizable value is also what we generally use for this. It's typically applied on an item by item basis. And generally, the idea is that the selling price, if it goes below the cost, you have a problem. As long as the selling price is above the cost, maybe you don't make as much money as you want to make on it. But if the selling price is below the cost, you have a problem. You have to write down the inventory. The question is, how much do you write it down by? And that's what this thing is all about. Okay. Now, we have a ceiling and a floor. The ceiling is the most that it can be held on the books for. And the floor is the least. And this is not just for international standards, this is for everybody. Okay, the ceiling is the most, and that is the net realizable value. What are you going to get out of this thing? You have the current selling price. If there are any additional selling costs, you have to subtract those out. So how much are you going to actually put in your pocket afterwards? Now, there may not be any additional selling cost, but for whatever reason, almost all these problems, there is an additional selling cost. Real life, I kind of doubt that happens, but anyway. So if there is an additional selling cost, you have to subtract it out, and then get a net realizable value. And that is the most you can have it on your books at. What are you going to get out of it? And the least is the net realizable value. So that's what we have up here. Minus our normal profit margin equals, you guessed it, net realizable value minus the profit margin. And that's the floor. So lower cost or market is going to bounce around in between those two. And this replacement cost is what we're going to use as kind of the decider here. Okay. So technical lower cost or market. Okay, so here we go. First thing to do is find the net realizable value. That's going to be our ceiling. I'm just going to copy this. I'm going to teach you guys how to be lazy. Very important thing to learn. Okay, so we have our current selling price is 260. Our additional selling costs. $20. So the net realizable value for the ceiling is 240. So this is the most we can have that on our books at. And we're gonna do the same thing for the floor. So this is 240. Net realizable value, so I just got that from. Let's make that green. Minus our normal profit margin. Now, our profit margin is 25%. So. Minus. Oops, sorry about that. 240. And this will equal our floor. Uh, 240 times 25 is what? 60?
Yes, 60.
Okay, so this is 60. All right, so we're gonna start to say, so this will be what? 240 minus 60 is 180, right? So this will be our floor. Okay, so this is what we're going to compare this replacement cost to. So the most it can be is 240. I don't have this up yet. 1 second. The least it can be is 180. The replacement cost is 290. So what is going to be our lower of cost or market? Oh, come on, guess. Be wrong once. So we're comparing the replacement cost to our ceiling and our floor. The ceiling is the most it can be, the floor is the least it can be.
Would it be the 240?
One way to think about it is it's always going to be the one in the middle. Whatever one's in the middle is going to be the one you're going to pick. And in this case, 290, 240, 180. Well, 240 is right in the middle between those two, right? So this is going to be the realizable value for this one would be. I just say the lower cost of market. 240. Okay, it says, calculate the lower cost or market if replacement costs A. Another hour or two and I'll do this formatting correctly. Don't worry. Okay, the replacement cost is 140. What would be the lower cost or market? So given the same thing as above, I should say put in there, refer to problem 5. I'll put that. Refer to problem 5, what would be the lower of cost or market? If the replacement cost was $140.
180.
I'm gonna add one here. Just to put a, just to drive it right into the ground. I'll make a 6B. Suppose the replacement cost was 210. Okay, so the replacement cost is 210. Now, that is actually in between our ceiling and our floor, right? So that's okay. We can, well, then we'll just use the 210. So if it's in between here somewhere, if the replacement cost is in between, we can just use whatever the replacement cost is. So the replacement cost in this case, and this will be the first, this will be the only one that uses the replacement cost of these three, is that it's in there. And you'll notice that 180, 210, 240, it's the one in the middle. So lower cost or market for this one would be 210. What I found oftentimes is people that were using a lower cost or market would just look at the replacement cost. You know, well, here's the replacement cost, write it down to that. You know, this inventory, we paid 300, now we can buy it for 290, we'll write it down to that. Actually, that's not how you do it. It's, work out the ceiling and the floor for them. And you find this also true for a lot of other things in accounting, and that is, once there's a loss established, then you go into a different set of rules and start looking at what is this really worth on the books. Until it's until the selling price is less than the cost, there's not a problem. And even if you sold it for $301, okay, that's fine, or even $300. It's the exact same price as if you paid for it. But when you started getting into those losses, then you started actually going into the calculations, and that's when it gets to be a little bit tricky. So until you're in that negative, is you don't have to do anything. Once it gets into that negative, then you got to jump through some hoops. Okay. Problem 7. If the current selling price jumps to 500, how would this impact the financial statements for Heifers and Gaap? Okay, another one of the things about Heifers is they allow for recoveries, and they do this for inventory, they do this for other assets. That, if you write them down and it turns out that now they're worth more, you can write them back up, right? So it's one of those things that the international standards like to have things done at the current values. So to them, writing it up is the same thing as writing it down. It's okay, putting it back to where it was is fine. Because, you know, the conditions changed. US standards are usually, you never write it back up. You are not going to record a gain on inventory you haven't sold. When you sell it, you know, then you have the you got a fully grown neighbor that he's got a bunch of mini bikes, and you think the guy with mini bikes would know how to work on them. He doesn't. Anyway, so, because I do. So you know, the different mindset, you know, that US standards are, well, when you sell it, you'll recognize, you know, the additional money, whereas the international standards are no, you have to put it on the books for what the value is. So if it jumps up to 500, let's take it matters how much one we take here. Let's take this one. Let's say at a lower cost of market of 240. The first one. Heifers. Write it up. $300. Depending on how they do the market, it may even go up further than that, but let's just say, let's say they're looking to reclaim it. Gaap. Do nothing. Which is my favorite thing. Okay. Any questions on that? That's it from the table. So Heifers allows for recovery. Gaap does not. And it kind of comes back to for Gaap, they don't like, especially when it comes to something that about inventory, they don't like people showing profit on inventory they haven't sold. You know, that's their whole, no, we're not going to write it back up thing. International standards say write it back up because that's a more accurate amount. You know, okay, if the selling price recovers, you know, you got to tell the reader of the financial statement know that those items are worth more than they were, you know, than you wrote them down to. Okay, any question on that? Okay, I think I already put this one in on Blackboard. Let me check and make sure before I leave. Oop. Oop. Yeah, so chapter 4 inventories. And again, very important, no test for chapters 1, 2, and 3. The handout, you still turn that in if you haven't already. Chapter 4 and 5, we're going to put those together. That's probably going to be a pretty significant test. I may even split up chapter 4 and 5 into 2 separate tests. There's actually quite a bit in there. And a lot of that stuff is stuff you might hit on the CPA exam. So, you know, if we can do that now, you get to this, start studying for the CPA exam if you're going to take it. You know, it's all that much easier. Okay, any questions?
No.
Okay, well, turn that in, and next week, let me check in and see what we're. I like this book. I don't like some of the problems that. Well, I'll figure it out. I'll figure it out next week. Okay, so I'll see you guys next week, and we're going to continue in chapter 4. Property, plant, and equipment, and probably investments. We'll do out of the chapter 4. Those probably have the most significant differences, and hopefully that'll be it for chapter 4. And then we'll go on to chapter 5. Okay. See you guys next week.
Have a good night.
You too.
Thank you.
See you.